Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to provide a general outlook for the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So the general thought process that I've had for the S&P 500 is that it generally climbs the wall of worry until it has a sufficient reason not to do so. Therefore, the best course of action is just to DCA, low expense ratio index funds, and wait, right? That tends to be the best strategy, and that trying to time the market usually does not work. Okay. Um, Now, what I do is I DCA it as long as it's at a low enough risk level. But obviously, recently the S&P did get a little bit of a pullback here, and so I wanted to talk about, what's potentially going on. What does it look the most similar to? You should know that even in bull markets, the S&P does occasionally get 10% corrections every year or so. And you can actually see that we've already had a couple of them. We had one in 2023. We also had one in early 2024. Some of the times, though, you'll see sort of like 5 or 6% corrections. And if it does get a 5 to 6% correction, it could still take the S&P down to its bull market support band. But I wanted to talk about, what does this resemble the most? Not because of the chart, but because of other aspects of the market. I think that if you were to look at the 10-year yield, that could give you some insight into what is potentially going on. In 2023, there is a period when the 10-year yield broke through this lower high structure. And essentially what happened is that you had a high, you had a lower high, and then there was sort of a breakout, right? There was a breakout right here. And then the 10-year yield came back and retested the 21-week EMA. Now, overlay the S&P 500, right? So overlay the S&P, and you'll see that the S&P back then got a correction precisely when the 10-year yield back tested its 21-week EMA. This is a blue line. That's when you got that correction. Now, if you go back and look at this cycle, what you'll notice is, this year, you'll notice there's something very similar happening, right? Where there's a high, a lower high, and then it breaks out, comes back down, tests that 21-week EMA, just like it did over here. And upon that test, you can see there's been a correction by the S&P 500. So I would argue that the reason why the S&P 500 is getting a correction right now is because the long end of the yield curve is going up. This is something we've been talking about all year. I said that the dollar would likely rally in Q4 and accelerate in December, potentially topping in early January. And if the dollar rallies, the long end of the yield curve is likely also going to rally. And if they rally, right, if they rally together and they continue to go back up to these highs, that's where you could see a short-term correction by the S&P 500. Now, I could theoretically be wrong about the 10-year yield continuing its rally. If you get a recession soon, then the 10-year yield would likely drop like a rock, because then it starts to price in recession fears more so than inflation reaccelerating. But as long as you don't see, inflation really reaccelerate, as long as you don't see the labor market completely fall apart, then we're not yet seeing a recession. And one of the things I've argued as well is, if you go look at initial claims, I've said that until they start printing 300K, it's not really recessionary, and they're still at around 220. A little bit of a spike recently back up to 242, but it came right back down to 220. So as long as it's below 300K, I don't really think it's a recessionary environment. That doesn't mean that you can't have corrections, right? You absolutely can have corrections, but until you see that take place, I think that would be sort of the argument. So if you go look at the 10-year yield, the question is, well, when would it top? I have thought that to some degree it could be mimicking what happened in 2016, where it basically gets a fairly explosive rally in Q4 and then kind of like tops out sort of late this year, early next year, and then starts to go back down. The dollar did something really similar back then, and so that was one of the reasons why I thought the 10-year yield would rally. And by the way, you could also look at say like the 2-year yield. We did a video on this when it happened. Here it is, right? I mean, here's the notation from it, where I basically said that like we should see the 2-year yield bounce back when the Fed cut rates. I think a lot of people are hoping that yields would fall after the Fed cut rates. That's not what we've seen. And I think the argument is that if they're cutting aggressively, which they have been since September, but there's not really a sufficient reason to do so, then the market might interpret that as potentially leading to another wave of inflation. Now, again, we're not seeing the labor market, uh, you know, be really tight right now. I mean, the labor market, if anything, is loosened up. And even Powell said that, sources of inflation, future sources, is not likely not coming from the labor market anytime soon, just because of how loose the labor market has become. So if you do see inflation reaccelerate, it would probably be for some other reason than the labor market, at least if it happens in the short term. So with yields rallying, it kind of takes the legs out of the rally by the S&P 500. Now, remember, when the S&P bottomed in October of 2023, it bottomed right after the 10-year yield topped. Okay? So the 10-year yield topped right there. That's where the S&P bottomed out. So if you're curious about where the S&P might start to move back up, I would look towards the 10-year yield to see when is it going to top out. One of the things you should know is that, assets like TLT operate inversely to the long end of the yield curve. So if the 10-year yield is going up, TLT goes down. If the 10-year yield is going down, TLT goes up. But if you look at TLT, a lot of times it will find double bottoms before moving up, right? A double bottom there, double bottom there, double bottom right here. Sometimes it'll sweep the low. So it's always possible that it sweeps the low as well or finds a double bottom. There are times where you'll see an asset put in sort of like a low and then sort of a higher double bottom low, and then it'll get a little bit of a rally. But then a lot of times, even when that happens, it then still resolves lower eventually. So be aware that you could see that play out. And if it happens, it doesn't mean that the 10-year yield can't go higher. If the 10-year yield does top out soon, it could just simply mean that the Fed's gone too far and then they need to start cutting really aggressively. But again, if you assume that the markets are, the economy's okay and that things are going to keep chugging along, then the argument here by the long end of the yield curve is that the Fed is cutting too soon, too quickly, and therefore the long end of the yield curve has to do what the Fed is unwilling to, and that's to basically raise the long end of the yield curve and take the legs out of the rally by equities. And again, that doesn't mean that equities can't eventually go higher. It's hard for them to go higher when the 10-year yield is going high, right? When the long end of the yield curve is going up, it's hard for the S&P in the short term to continue that rally. And so what I'd like to do also is I'd like to go over here to the equity side of the Cryptoverse and look at year-to-date ROI of assets like Apple in 2024. I make the comparisons to 2023, and you can kind of see that Apple had a little bit of a correction in 2023 right around this time. But if you look at the indices, right, if you look at like the NASDAQ in 2023 compared to 2024, you can see that the shape looks really similar, right? And it's also tracking higher. But the one difference is that last year, the 10-year yield topped here, right? Now we're seeing the 10-year yield continue to move up. So you could see some divergence if the 10-year yield continues to move higher, right? And I think it's also always important to remember that. I would also take a look here at the risk on the S&P 500. It has come down at least somewhat recently, especially with markets getting that correction recently when they went all the way up, basically up to like 6,100, the S&P, and then now it's dropped back below that level. Let's see if it actually loads. Normally it loads a little faster than this. It's basically like 100 years of data, which is why it tends to take a while. But we'll see if it loads here in a second. But let me reload it and see if we can get it to show up. But the S&P 500 risk level has obviously dropped a little bit recently just because of that correction. And I would again defer to the long end of the yield curve, right? As long as the long end goes up, it will be a drag on risk assets. But if you can see the long end start to show weakness, then you would likely see risk assets accelerate again, just like they did in 2023. So here's the risk on the S&P. So you can see it's finally come back down below 0.8 after being there for a little bit of time, right? So something certainly interesting to follow. But those are my general thoughts on the S&P 500. I want to remind people that my strategy with the S&P is to just DCA low expense ratio index funds at low enough risk levels, right? So, and I don't, it's not like I wait for 0.5 risk. Normally, I just DCA below 0.75 risk, somewhere around that level, because the S&P will often spend many, many months above, high risk levels. It's not the same as crypto, right? It doesn't drop as much as crypto does. So I generally DCA low expense ratio index funds up to a higher risk level. One of the other things I wanted to mention, in case this does evolve into a larger correction, is that if you look at the S&P divided by M2, there was actually, there have been some similarities between sort of this move and what happened in 1996, right? There was a big move by the S&P in 1996 that started from this same level right here that we did in October 2022. It then rallied on up to this level, and then it had a larger correction down. That correction was actually about 20%. So if you were to see something like that, obviously it would be detrimental to the cryptoverse. We haven't seen that yet. Back over here, when we got that correction, you can see that the S&P basically fell to the 20-week SMA, and then it pretty quickly fell below it. If you look at it today, it already fell to the bull market support band, but it has not yet fallen below it. But I would keep an eye on that. And there are some other similarities. For instance, if you were to look at interest rates, the Fed also they cut sort of in response to that. What was interesting is they cut around that drop, and then the market exploded higher again, and then they had to raise rates. So imagine if they did that. And the funny thing is they cut rates from 5.5% down to 4.75. Right here, they just cut rates from 5.5% down to 4.5. I hope they don't have to raise rates again. Powell sort of scoffed at the idea that they would have to raise rates again, but he did say anything's possible. Let's hope that they don't have to do that. I'm sure it would be very painful if we had to go through that process where they sort of bottomed out and then went back up and then fell off, because that's essentially what happened during the dot-com days. They cut too soon. You had a correction. They cut too soon, and then you had sort of the final phase of the bull market. So certainly something to keep in mind here, because history can have a way of repeating itself. I mean, and by the way, if you look at the Nasdaq divided by M2, it's already higher than where it was in the dot-com era, right? I mean, it already has sort of surpassed that level. You see that right there? Let me get rid of this fib retracement, right? But you can see where it was back over here, and that was also, the Fed cut rates too soon. The Nasdaq just accelerated higher. So I would, and by the way, just because you have it be a top here doesn't mean it has to be a top here. It could continue to go up further, right? And I mean, in fact, you already had a pretty big correction right here. Okay, you don't really see the exact same thing over here. I mean, there are some, but they look kind of small, I guess, comparatively. They lasted a much shorter period of time. But, I think it's interesting to follow the S&P to try to figure out, how is it going to move based on the long end of the yield curve. When you get the long end moving up, you will see these corrections by the S&P. But whenever the long end tops, that's when the S&P should start moving up again. The only way that it wouldn't move up again, more than likely, would be that if there is an economic downturn caused by, monetary policy lags, right? So you could see something like that. But even in the case, of an inverted yield curve that precedes recessions, you should remember that not all recessions are the same, right? I mean, sometimes you get just 20% drops, like you had in 1998, even though that wasn't even a recession. But like in 1981, here's a recession where the market just dropped 20%. Here's one where the market dropped about 20%. I think a lot of people sort of look at it like this and assume that any recession's got to be like a 50% drop, but that's not always what happens, right? It doesn't always have to be like that. So please remember, there's a lot of ways this market could play out. Be open-minded, have a plan, try not to time things perfectly because you're probably not going to be able to. Thank you guys for tuning in. Subscribe, give the video a thumbs up, and I'll see you guys next time. Bye.